Welcome to Talk Tickers, the deep dive designed to get you smart on the topics that are shaping global finance. Today, we are pulling back the curtain on the invisible infrastructure of the stock market. We're talking about the secret plumbing, where trillions of dollars in stock trades happen every single day, completely out of sight of the public exchanges.
It's a huge paradox in the modern financial world, isn't it? We have the fastest, most technologically transparent markets ever, and yet the biggest, most influential trades are increasingly executed in the dark. Our mission today is to explore alternative trading systems, or ATSs, and specifically the most opaque subset, dark pools.
Okay, let's start right there with the fundamentals, because the terms can get confusing. What exactly is an ATS, and how is it different from, say, the NYSE?
Right, so an ATS is simply a regulatory term used in the US and Canada for a trading venue that is not a registered exchange. Think of it like a private marketplace. Its job is just to match buyers and sellers. And crucially, they operate under a different regulatory framework. They're typically regulated as broker-dealers, though the SEC has to approve them. They provide the trading mechanism, but they don't set the deep structural rules for the whole market.
Okay, so if an ATS is a private marketplace, what's the trigger that turns it into a dark pool?
It's the intentional opacity. A dark pool is a specific type of ATS that deals with major U.S. stocks. And it deliberately does not display its quotes or prices publicly. So if you look at the public tape, you see the trades after they happen, but you don't see the orders just sitting there waiting to be filled.
So if the public market is a well-lit store window, the dark pool is more like a backroom deal. The obvious question then is why? Why do the biggest players, pension funds, mutual funds, actively want that darkness?
Well, it all comes down to scale and, frankly, self-preservation. When you're a major pension fund and you need to buy, say, 2 million shares of a stock, if your intention becomes public knowledge, it's instantly weaponized against you. This whole concept is called market impact.
And what does market impact mean for our listener, practically?
If you place a huge order on a public exchange, the size of that order screams to the market that a big move is coming.
So if you're buying 2 million shares, everyone assumes the price is about to go up.
Exactly. And that transparency allows the high-speed traders to just swoop in.
The race to exploit that information.
It's a race to exploit the information asymmetry, absolutely. These high-frequency trading firms, they operate in milliseconds. They see that institutional order coming, they trade ahead of it, and they profit from the tiny price increase that the institution's own trade is about to cause.
That sounds a lot like front-running.
And that's where the distinction gets really important. Illegal front-running is when a broker uses non-public client info to trade for their own gain. What we're talking about here is more latency arbitrage in its legal form. It's exploiting the delay between when an order is placed and when it's fully executed across all the different venues. The bottom line is, an institutional investor's goal of getting a good price is always at odds with the transparency of the electronic order book.
Which explains something former SEC Chairman Arthur Levitt reflected on, right?
Yeah, he noted that when regulators pushed for electronic trading, they just fundamentally underestimated how quickly and how sophisticatedly participants would adapt to exploit these new information dynamics. The dark markets weren't really created just for secrecy's sake. They were created to avoid the enormous costs institutions were paying when the hyperspeed market used their own intentions against them.
Got it. And before we move on, you mentioned ATSs are a U.S. term. Is there a European equivalent?
There is. In Europe, under MiFID regulations, the comparable venue is generally known as a multilateral trading facility, or MTF. It serves the same basic purpose, a non-exchange venue for matching orders, just under the EU's specific rules.
Okay, let's pivot a bit to the history here, the fragmentation of the market. This didn't just start with dark pools. Technology splintered the market first.
Absolutely. The first real wave of fragmentation back in the late 90s was all about electronic communication networks, or ECNs. Names like Island ECN. Their big innovation wasn't being hidden, it was speed.
So they were faster and cheaper.
Exactly. Faster execution, much lower cost than the big exchanges. They were still very visible, but they proved that liquidity didn't have to all live in one building in New York.
But the idea of hidden trading, that actually premates the ECNs, doesn't it?
It does. The true precursor to the modern dark pool was what they called a crossing network. The most famous early one was POSIT, launched way back in 1987. These were systems built specifically to handle huge institutional block trades.
Then how did they manage to hide the market impact back then?
They did it by matching orders at a a predetermined neutral price, usually the midpoint between the best public bid and offer. And critically, they did this in periodic crossing sessions, maybe just once an hour, not continuously. The system only confirmed the match after it was done. Your order size was never revealed beforehand.
So that proved the concept. And then in 2007, the SEC steps in with Regulation NMS and kind of accidentally throws fuel on the fire.
It really did. Reg NMS was built on this idea called the order protection rule, which required orders to be sent to whatever market was showing the best displayed price.
Sounds good on paper.
It sounds great. The goal was to protect the consumer, make sure you always got the best visible price. But the immediate consequence was that it forced everyone to chase the best price across dozens of competing venues. It basically validated the ECN model and fragmented the market into all these little pools of liquidity.
Which in turn created a playground for high-frequency traders.
A perfect playground. All those tiny split-second price differences across 50 different trading locations. That's what their algorithms live for.
So the big funds, seeing they were getting picked off left and right, had an even bigger incentive to run for cover, to go dark.
Precisely. They needed a place where their order was safe from those high-speed, vulture-like strategies. Former SEC Chair Mary Shapiro even acknowledged this. She said the fragmentation showed the success of competition, but also the unintended consequences that drove the deepest liquidity into the shadows.
This takes us right to the heart of the regulatory concern, which is the operational risk. So many of these dark pools are run by the same big broker-dealers who are also trading for their own accounts. How messy does that get?
It gets extremely messy because all the lines of business just blur together. A multi-service broker-dealer running an ATS. They're often using the same IT systems, the same people, the same data as their other trading desks.
So their own trading desks, the ones trading for the bank's own profit, are tied into the dark pool's operation.
They're highly intertwined. And the potential for a conflict of interest is just immense.
Because the operator knows exactly what orders are coming in before anyone else does.
Exactly. They have an incentive to internalize that order flow, to execute a client's trade against their own capital before they even show it to the rest of the dark pool. And while they can sometimes be good for the client, it gives the broker-dealer a massive information advantage. You're trusting them to act in your best interest, but they also have their own P&L to worry about.
This complexity is why institutions have to worry about something you mentioned earlier, adverse selection. How should we understand that risk?
Think of it like fishing. You want to fish in a pond with lots of other big, slow-moving fish, other long-term institutional investors. But if your dark pool starts attracting too many sharks, those super fast, sophisticated trading firms,
then you suffer adverse selection.
Right. It means your big order is constantly getting matched with the fastest traders who are only there to profit from your size, not because they have a real long-term investment reason.
Your execution quality just tanks.
It plummets. So the key for any big fund is knowing who is allowed in the pool and what they're allowed to do.
And this lack of transparency led directly to major regulatory action. The Citigroup case from 2018 seems like the perfect example.
Oh, it's a critical case study. In September 2018, the SEC charged Citigroup Global Markets for making some really egregious misrepresentations about its Citi Match dark pool.
What was Citigroup promising its clients to get them to use the platform?
They marketed Citi Match as this premium, safe venue. They explicitly assured users that high-frequency traders, the sharks, were not allowed to participate.
A safe space for institutions.
That was the pitch. But the reality was completely different. The SEC found that 2 of the pool's most active participants absolutely qualified as HFTs, and between them, they executed over $9 billion in orders.
So the institutions were paying for a protected environment that was actually filled with the very predators they were trying to escape.
That's it in a nutshell. And it gets worse. Yes. Citigroup also failed to disclose a major operational flaw. For more than 2 years, almost half the orders sent to Citi Match. They weren't even executed there. They were routed to outside venues, other dark pools or public exchanges that didn't have the premium features Citi advertised.
And the clients had no idea.
No idea. The trade confirmations they got back incorrectly said the order was executed on Citi Match. It was a complete failure of controls and disclosure.
And the regulatory hammer came down on both the operation and the affiliate running it.
Correct. The SEC found that the affiliate, a group called Co-Show-R, had failed to even register properly as a national securities exchange. The whole case just hammered home the point that operating in the dark does not exempt you from being totally transparent about your process.
That really sets the stage for the big regulatory pushback. I think former SEC Chair Mary Jo White summed it up perfectly when she said that dark pools need to operate with transparency about their operations, even if the orders themselves are hidden.
And that philosophy is what directly led to the huge overhaul in 2018, Regulation NMS Stock ATSs, which created Form ATS-N.
The moment the veil was finally lifted, what did Form ATS-N force these venues to actually tell the public?
It demanded standardized, incredibly detailed disclosures on almost every part of their operations. They had to explain, in plain English, how orders interact, how prices are set, the exact matching logic. But most importantly, it forced them to disclose the relationships between the ATS and its own broker-dealer affiliates.
So we finally get to see how the operator is trading, not just what is being traded.
Precisely. Form ATS-N requires them to spell out the capacity in which their affiliates trade. Are they an agent for another client? Are they a principal using the firm's own money? That level of detail helps everyone assess the potential conflicts before they send a single order.
So while the U.S. went for operational transparency, the European Union took a totally different route with MiFID II and its volume caps.
Yeah, MiFID II, which came in around the same time, was much more concerned with protecting public price discovery. The fear was that if too much trading went dark, the public prices would become unreliable.
So they just put a hard limit on it.
A very hard limit. It's a double cap system. Dark pool trading in any one stock is capped at 4% of total volume over 6 months. And then there's an overall cap of 8% across all dark pools combined for that stock. If you hit those limits, dark trading in that stock gets suspended. It's a really blunt instrument designed to force liquidity back into the light.
This whole regulatory struggle just perfectly illustrates the core trade-off, doesn't it? Dark pools are necessary for big players to be efficient, but that very efficiency puts market fairness at risk.
That's the central tension. They really do fill a legitimate need. They protect pension funds and mutual funds from predatory strategies. And studies seem to confirm that a moderate level of dark pool activity, say up to 30 or 40% of total volume, it doesn't really impair price discovery that much. So regulators are just constantly trying to find that balance point.
So what does this all mean for the future? Dark pools are clearly here to stay, and they're constantly evolving with new tech, like LiquidNet's algorithms that can find matching large orders almost instantly.
They're indispensable infrastructure now. They are a technological solution to a problem created by technology, the incredible speed of modern trading. But that very speed means the regulators will probably always be playing catch-up.
Which brings us to our final provocative thought for you to consider. If this arms race between speed and fairness just keeps escalating, and the algorithms get even more complex, how long until regulators stop focusing just on transparency and start looking at ways to actively slow down the system itself? If pure speed is what allows for the arbitrage, will we eventually see things like mandated latency or engineered friction just to protect market integrity?
That battle over the very fabric of time in the markets, milliseconds versus fairness, that is going to define the next generation of financial regulation.
Fascinating stuff. Thank you for walking us through the hidden side of the market today.
My pleasure.
We'll see you next time for the next deep dive.